morning, everyone. Welcome back to another episode of Policy and Profits. I'm Anthony Esposito from Island Capital, the profit side of the equation. E.J. Antoni, good morning, my friend. How are you?
Good morning, Anthony. Joining for the policy side of the equation. It's been another crazy week, especially on the policy front. But I'm hanging in. How are you doing?
I'm doing well. I am trying to win at life today. That's proving to be a little difficult at the moment, but we'll see what happens. Um, So I want to start off by saying, I mean, obviously politically, there's been a ton going on as far as the race, and that is what it is. I'm not even going to touch it right now, but I want to start off with some of the economic numbers that came out this week, and start off with expectations because you were out on not only the New York Fed inflation expectations, but we were also out on consumer expectations, or you were also out on consumer expectations earlier in the week. So those numbers came out on the 15th. I thought your breakdown and your analysis was very interesting. Where do we stand as far as inflation expectations now that we have the Fed in cut or maybe cut or kind of cut, or we cut, maybe we'll wait mode, or whatever their mode is? Where are we now with inflation expectations, and what does the consumer look like based on rates and those numbers?
Well, Anthony, I think the short answer to your question is that nobody believes the Fed anymore. We're still not seeing those inflation expectations get back down to the 2% target. And you and I both know that it should be zero. We shouldn't be targeting any inflation at all. But the fact is we're still not back to that 2% target. And I think the reason for that is because people, again, just don't believe the Fed. Now, it's one thing if the year ahead inflation expectations still aren't at 2%. If people think, all right, the Fed's going to take a little bit longer to really get this thing under control. But when you start looking at medium and even long-term expectations and you see that we're still not hitting that 2% target, that's a problem, especially when you're talking about numbers that are getting close to 3%. When we look at numbers from the Cleveland Fed, for example, where they stretch it out to a 30-year time horizon, if you're expecting that the next couple of years are going to be elevated inflation and then we're going to be back down to 2%, over 30 years, you're talking about an average rate that's darn close to 2%. But when even that number, again, is not getting to that 2% target, we have a problem. Nobody believes the Fed. The 2% target's dead.
So where are the expectations right now? I know I had the numbers, but what are the 1, the 3-year, and the 5-year expectations that were out this week?
You're looking at about 2.7, 2.8, and 2.9%. So again, the fact that you're near 3% and not near 2% points us to the fact that we're not heading to that target. That target, frankly, just isn't the target anymore. And unfortunately, I think part of the reason for that is how desensitized people have become given the 40-year high inflation we just had. It's remarkably similar to what happened 40 years ago when Paul Volcker brought inflation down from double digits to 3% and change, and everyone cheered. Except we were still at 3% and change. We didn't actually get below 3% until many years later. So again, the fact that we had such high inflation, I think, has desensitized the American people to the point where I think a lot of people, sadly, might be willing to tolerate those what we would have previously considered to be very elevated levels of inflation. But now I guess people are saying it's better this than what we had before.
I mean, look, we've been desensitized to a lot of things in this country, and we are definitely there are so, I say it all the time. There's so many fires lit that you can't see them, and that's I really feel that way, and this is definitely part of it. Fed policy, fiscal policy, definitely part of the problem. You talk about how this affects people. There was a survey out. We have a visual of it. Your debt delinquency expectations out from the New York Fed survey. Tell me about that. What are people seeing as far as, and how are people feeling as far as their personal situation? Because being desensitized is one thing and just kind of head down, move through life. But when you stopped and you're asked the question, where are you personally and how do you feel? Then it kind of comes to light. So what is this showing us?
Well, this is basically showing us that the number of people who believe that they're not even going to be able to make minimum payments on things like credit cards over the next 90 days, that share of the population continues rising. And a lot of analysts are dismissing this because it's not at a historically high level yet, but there's a couple of reasons for concern. One is the fact that I should say the rate of increase. That's concerning. How quickly things are moving up, and the fact that the percentage of people who believe they're going to fall into this category keeps going up. But the other difference is the debt loads that people are under today. If you fall behind on your debt when your debt is a very small portion of your income, that is almost like a speed bump under tread. And okay, you're going to fall behind for a little bit, but you're going to eventually be able to dig yourself out of that hole without having to resort to things like personal bankruptcy proceedings. Today, not the case. We're looking at over 1.1, soon to be 1.2 trillion in credit card debt. The American consumer is paying over $300 billion annually right now, just in interest on those credit cards. And you're not only seeing the record amount of credit card debt, but mortgages, student loans, auto loans, you name it. It is all piling up. It is all adding up. And so, again, this is where I think the consumer is really starting to struggle, is really starting, to hit the wall. And what does that end up looking like? Well, eventually that's got to hit corporate earnings, right? And that's where, I think, unfortunately, you're going to start seeing more misses and more, even if they're not misses in terms of earnings reports, Anthony, you'll start to see earnings expectations revised downward as corporations begin to realize we're not going to hit our targets. We better reduce those targets.
Yeah. Well, Wall Street's very good at lowering expectations when they know things are not as good. So you look at the beat and the miss ratios as you come through earnings season is one thing, and they can kind of fudge that, and they can kind of lower expectations so that the beats look good. What you want to look at is what are not only forward earnings, but what are the realized earnings? What are reported earnings versus previous earnings? Not only what they are versus expectations, but what are they in reality and in real terms? And those numbers do not look good, and those numbers look like there's a lot of headwinds in front of them moving forward. As we talk about, so I actually love this. This is really informative and to the point, as usual. So as we talk about people's debt load, and we all know that, people do not have enough cash in general. I think the number is 70% of Americans don't have up to 2 months of bills saved and in the bank and available.
Yeah.
So that's a problem. We talk about delinquencies. I was reading an article yesterday specifically about auto loans, which are more and more people are more and more underwater. And those delinquencies are rising. And to your point, not only are they rising, but the rate of increase in delinquencies is rising, which is concerning. The Fed went out and said, we're going to help, we're going to cut 50 bips. So they did that last month. What is that doing to rates? How is that helping people manage the debt load? Because for me, I see the long bond yield rising, so rates rising long term. I see, and we have a visual of U.S. mortgage rates pushing higher since the Fed cut rates. So explain to me what is going on with rates, and did the Fed actually help people manage and service their debt by lowering the rate on that debt, or is the exact opposite happening now?
Well, Anthony, this is such an important topic. I'm so glad you're bringing this up, and you're absolutely right. We're not seeing those lower rates trickle down to the consumer level. We just saw the average interest rate on credit cards hit a new record high, which again plays into what we were just talking about, the record amount of interest that people are paying on those credit cards. I think there's really only two explanations for why we're seeing what we're seeing in terms of interest rates right now. One is this idea that maybe markets are believing the Fed really is going to pull off this soft landing, which they've never done before since 1913 when the Fed was created. They have yet to pull off a soft landing. But if they do that, it means that not only should equities be taking off, but we should also be seeing the same thing with fixed incomes. We should be seeing rates rising there as well, because the only way you're going to be able to draw money into those investments, obviously, is offering a higher yield. And if everyone believes that everyone's going to be doing better, that all of our rates of returns are going to be improving, again, like the economy's picking up in the case of a soft landing, then everything kind of checks out. But I'm really skeptical of that, because the Fed has never done it before. So is the market actually getting fooled here? Are market participants really falling into this trap of believing the Fed is going to pull the rabbit out of the hat here? I don't know. I think maybe the more likely scenario is the fact that Creditors right now are looking at this environment and realizing two things, both of which you brought up earlier: the monetary stimulus and the fiscal stimulus. In other words, government continues to spend more than it has, continues to borrow more than it can afford, and continues to rely on monetary policy to pay for it all. That's a highly inflationary scenario. So now imagine you're a creditor. If you're going to lend money, you want to make sure that the money you're going to get back has an increase in not just nominal value, but real value. So now you're going to demand a higher yield than you did previously, because you need to take account for all of the inflation that you're going to see during the period in which you're going to have your money lent out to someone else. So for a 30-year mortgage, you need to account for 30 years worth of inflation. So maybe you're not going to be able to reduce your lending rates at all. You're going to have to increase them if that's the case. And I think that's a much, much more likely scenario than this idea that everyone is falling into this frankly ridiculous belief that, again, the Fed is going to pull the rabbit out of the hat and achieve the soft landing.
Yeah, that's a great point. And I think as well, it warrants stating that, credit is tighter than it's been in the past. And you need to be compensated for the risk. The risk is higher as you're lending money out now. And we see that as far as the delinquencies going up. So rates higher, even though the FOMC is cutting rates. FOMC is cutting rates. We're still printing dollars like it was going out of style. Still inflationary pressures. Looking forward 1 year, 3 year, 5 years, we're still well above the 2% target. But everyone thinks that we're pulling off the soft landing and everything's okay. So it's kind of like the same thing as always. Everything's okay until it's not. Don't pay attention to the man behind the curtain. I hate to be that, not even negative, but just that realistic about where we are. But that's where we are, and I think everyone feels it. And that's honestly why, to skew off quickly, that's why people are looking at, President Trump's ideas and policies and what he has done and what he proposes to do again, and Kamala Harris's policies, what she's done in the White House with Biden and what she proposes to do again. And that's why you have sites like Polymarket. I just pulled up Donald Trump at 61%, the favorite to win the election. And then
Wow.
we have predicted Donald Trump at 55%, Kamala Harris at 47%. So, people are feeling it. These are real issues. These are real stories. And that's the real world. I want to step over to the markets just for a second, because I'm continuing to move through, obviously, and trade my model. The model now, just for a real quick snip, the model is long. It is positive. We have made some money on the way up. The best way I can put it is I am net long and holding my nose. I continue to do that because that's kind of the process. But I will say that as I get long at these levels with the current market structure, I am long with less exposure. So these are not the fat trades that I've seen in the past and will see again. To the
Mm-hmm.
upside, they are to the upside. The model is leaning long. I'm long, but I am reduced exposure long because I really am not fully enthralled with what's going on in the market. And some of those anecdotal, to get away from the technical so much, but anecdotally, we are way leaning and over leveraged long. So just as a few points, I was looking at the Bank of America FMS survey, the fund manager survey from a week and a half ago, and we're looking at cash levels down below 4%. So you can see, we just threw up
Mm-hmm.
the chart. You can see what this is saying is that fund managers are sitting on the lowest levels of cash, or historically low levels of cash. So meaning they are fully invested or over invested in the market, meaning we are all in. That's not a bullish sign. That's actually a contraindicator, as people have less cash on hands and historically low levels of cash. Those have historically been sell signals in the market. This is one that I think is worth mentioning and worth noting. Um, Positioning in the U.S. stock market futures. So we talked about this as well. This is the next chart that we have. I'm going to run through a few charts today, kind of get into my world. We talked about this 2 weeks ago, and I think this is really important because we're at extended levels as far as positioning long in U.S. stock futures. Not only is there a massive amount of exposure or extended exposure long, but the leverage included, the leverage inherent in these products, these derivative products, is massive. So you have a situation where the fund managers or investors are very long contracts, futures contracts, and in addition to that, very levered into those contracts. So that creates another scenario where we are very long, very levered, and on a turn, those 1, 2, 3, 5% moves down become 5, 10, 15% down because of the unwind of that leverage. So again, it's positive in that everyone's so positive. It is a contraindicator. It is a sell indicator. Everybody is just too jammed into the room. If anyone yells fire, the exit can't come fast enough. And I think
Mm.
that's kind of what we're looking at. Um, I have a couple of good friends that work in prime brokerage on the sell side, kind of alerted me to this, and I found a nice visual that was put up by Torsten Slok over at Apollo. He's their chief economist, and this is looking at prime brokerage borrowing. So as you run a fund, whether it's a hedge fund, a long only, prop shop, you're borrowing money from your prime broker as one of their services. You borrow those funds to either short stock and fund the short, or you borrow those to leverage up. So if you have a $10 billion fund, you can leverage that up to 15 billion, 20 billion, 25 billion, and you pay interest on the loan that you're actually effectively taking on to buy stock. That's one of the
Mm-hmm.
services of the prime broker. There's more than $2 trillion in borrowing right now. And you can see by this chart, we're at all-time highs. It was 1 trillion before COVID. We're now at 2.3 trillion. So these are big numbers. And what is this saying again? Very long, very levered. Again, this for me is becoming a dangerous spot for the market. Not to say that we can't push higher, and we very well may. However, these are becoming extended. They're contraindicators to the upside, and they present real risk to the downside as this leverage and this massive positioning long needs to unwind. The last one, which I thought was pretty interesting, and then I'll stop torturing you with all the stock market charts, is global ETF inflows. So there were $500 billion of net inflows in the third quarter of 2024. That was the most on record. And it was double the average that we've seen over the past 3 years. This is a massive push into long equities globally. The first 3 quarters of 2024 inflows were $1.45 trillion. So we're not only seeing institutionally, as far as FMS survey cash on hand, as far as institutional derivative exposure, stock futures exposure, uh, prime brokerage, use of capital. All of these are more institutional indicators that the big boys are really levered and long. But you
Mm.
start to look at ETF flows, and a lot of these ETF flows will flow in from individual retail investors or financial advisors, private banking, whether it be Merrill Lynch or Smith Barney or whatever the case may be. You are moving into now the retail investor very, very heavily long. A lot of capital flowing into the market. We are just overexposed long and overextended and overlevered. I do think that the move down, because we have so much leverage and the positioning is so one-sided, when it comes, that's why I love my system, and I will hopefully see it coming as we start to approach and recognize it. Can be out or can get short and take advantage of it. But when it comes, it's going to be, multiplied by X versus what it would be if we didn't have this leverage in place and if we weren't so one-sided. But we are. I just think it's worth noting as we talk about the profit side of it that there is substantial underlying risk in the market just in positioning. Simply in positioning, we're seeing a lot of contraindicators to say that there is substantial downside to come. And when it comes, it's going to be multiplied. It's going to be exacerbated by the positioning.
So, Anthony, I love the analysis. One thing I'd love to get your take on, though, is there's been a lot of talk about how when Trump has been ahead in the polls, the equity markets have rallied in
Mm-hmm.
order of magnitude more than when either of his rivals have been ahead in the polls. So either Harris or Biden.
Mm-hmm.
And it almost feels like equity markets are really counting on Trump to pull us out of the current economic slump and solve all of the problems that are likely to come in 2025, like commercial real estate. That's something we've not only talked about here on the show, but something that you and I have actually written about before in a couple of op-eds. So, I mean, how much do you think of that is at play? Where you mentioned that Trump is ahead right now in the betting markets, as as that continues, if it continues, hopefully it does, hopefully the lead widens even more. Do you think markets are going to continue to maybe have some of this irrational exuberance, if you will, where as Greenspan said, they're going to continue rallying on the hope that Trump and his policies are what we're going to have in January, as opposed to Bidenomics 2.0?
Yeah, it's a great question, and actually two answers. One, directly to answer it, is I do think there'll continue to be a push into equities, into risk assets, with the idea that Trump will take office. What's funny to me is that people talk about the Trump trade, and depending on where you look, it's a different trade. So you can talk about the Trump trade and talk about financials at all-time highs. You can talk about crypto. You can talk about DJT as a proxy, his Truth Social
Yeah.
holding company, right, as the proxy. And then you can talk about, well, energy. Energy may be a Trump trade because he'll be more energy friendly. The industry domestically in particular will start to kick back in, start to reignite. Okay, so we can talk about those industries. I read an article yesterday about onshoring, and now they're talking about companies like Eaton and Hub, those industrial companies, those production companies. Okay, that's the Trump trade. So it seems to me that everything's the Trump trade, because everyone is so sick of these restrictions and policies that are stifling growth. Everyone is sick of the inflation that we're dealing with. Everyone is sick of swimming upstream. So it seems like no matter who you talk to, there is a Trump trade. The Trump trade is up, and the sectors are really the only sectors I've found that aren't part of the Trump trade anywhere are renewables, solar, some of those pet projects that are part of the Green New Deal that Trump would not be as supportive of, or would not fund with government taxpayer dollars. Let's say that. I think Trump's view is, and he's been open about this, and I think people overlook it, is if there is something to be done there and there's something productive there, let's have at it. However, this is a free economy, and we're going to let the strong survive. We're going to let what works and what is produced and needs to be produced. And if you can come up and you can actually add value and produce technology or energy in a way that we didn't think of before, that's actually sustainable and usable, great. But I think as far as those industries, those would be the only two that I can think of, or the only group that I can think of that would no longer get no longer be functioning on tax dollar payments, government funding, that may not be a part of the Trump trade. So the Trump trade is up, I think, for multiple reasons. A, people are just sick and tired of this administration and the stifling of business and the stifling of growth. I think that there is a lot of enthusiasm about what Trump did the first time and what he will do again, as far as bringing jobs back onshore, using tariffs, maybe in effect, maybe just as a threat, to get companies to come back to the U.S., produce in the U.S., and the reduction in inflation, starting with energy, that will help
Mm-hmm.
all of the consumers and help the country. So I think the Trump trade is real. I will say, and this is the second part of the question, and I've spoken to quite a few guys about this week. I do think that because of how levered everyone is and because of how long everyone is, I could see a sell off into the election. And this is why I say that. If you are very long, very levered, and everyone's kind of in the same trade, right? Because we have this environment where the smaller hedge funds have kind of gone away. And now you have either larger family offices or these large multi-strats, the Balyasny, the Citadel, the Millennium, the .72s. Everyone's levered, everyone's essentially long, and everyone's essentially in the same trade. How they realize that trade may be different. They may realize it one way or the other, whether it's a derivative instrument or equities or fixed income in a public company, or whatever the case may be. If those trades are all long, levered, and concentrated, and there's a known unknown in the election, right? That's a known unknown as far as a volatile event coming up. I would think that there would be a reduction in exposure, a trimming of exposure, a de-risking heading into it. It makes sense to me that it would happen. I don't think the hedging part of it would be as effective as de-risking. As they say, the best hedge is to just de-risk. So I could see a bump down heading into the election. So that gives us another 2 weeks for guys to take a little bit off the table, which in effect would be, in my mind, would be somewhere between a 3 and 7% sell off from current levels. and then we kind of see the election. If the election comes through, Trump is elected, I would expect the move up to continue. If Kamala Harris wins the election, to be perfectly honest, I would expect a very nasty, ugly market, a rush for the exits, and what should be, a 10 to 15% sell off could be significantly worse than that, depending on the market's reaction, the unwind of leverage, the margin calls, and all those things start to play into derivative products, who's trading options, who's the delta neutral guys that need to be shorting stock because they're taking exposure one way or the other. It starts to become a snowball effect at that point. But I would say move up is the Trump move across the board. Heading into the election, I can see a bump down just on a de-risking, and then coming out of the election, if there is a Harris win, then I think we could see a real retracement in the market for sure.
Yeah, and to that point, Anthony, here's that perfect overlap between policy and profits. If we get that Harris victory, and you're anticipating your cap gains taxes are going to go through the roof beginning in 2025, it makes all the sense in the world to realize your gains now, and then to maybe do something a little different with that money, and maybe find some tax shelters, whatever the case may be. But I think that's spot on.
Yep, that's a great point too. As far as selling at lower tax rates, your real return is higher, obviously, something that we could see as well. So we'll keep an eye on it. It's definitely obviously on my radar day to day. The work on inflation expectations and where people stand, what people feel as far as can they pay their bills, is huge. So really appreciate that today, EJ. Happy Friday. Have a great weekend. Thank you again, sir. And we'll do it next week.
Sounds good, Anthony. Same to you. Happy Friday. Have a good weekend. Enjoy some time with the family. We'll see you next time.
Thank you, sir.